So this one will be the risk-free rate. That will be expected return for the market. Then this one will be the standard deviation for the market. The standard deviation for the market. So this is now our capital market line. That will be the capital market line. So this is the risk-free rate. Then that is expected return for the market. When this part will be the market, that part will be the market. So that part will be expected return of the market minus the risk-free rate, which is the same as the risk premium. The risk premium, that which will be the same as the risk premium. Sorry, this is capital market line. So this is the risk-free rate. That one is expected return for the market. This one is the standard deviation for the market. That would be the standard deviation for the market. So the capital market line normally originates from the risk-free rate, then it will pass through the market portfolio in that particular direction. So now we can add there a paragraph by noting that the capital market line is normally used to estimate the returns of the portfolio. Is normally used to estimate the returns of the portfolio. Is normally used to estimate the returns of the portfolio. Is normally used to estimate the returns of the portfolio. To estimate the returns of the portfolio. And it is normally expressed as follows. So it is normally used to estimate the returns of the portfolio, and it is normally expressed as follows. It is normally expressed as follows. So to get the return of the portfolio, it will be equal to risk-free rate, then plus in brackets expected return of the market minus the risk-free rate. We divide by the standard deviation of the market, then we multiply by the standard deviation for the portfolio. So when you want to compute the return for the portfolio, will be equal to risk-free rate plus in brackets expected return for the market minus the risk-free rate. We divide by the standard deviation of the market, but we multiply by the standard deviation of the portfolio. Then we multiply by the standard deviation for the portfolio. We multiply by the standard deviation of the portfolio. So this is meant to be our capital market line equation. The capital market line. The capital market line equation. The capital market line equation. That is meant to be the capital market line equation. The capital market line equation. So that's now the capital market line equation. So now we can have a paragraph by noting that the difference between the return of the portfolio, the difference between the returns of the portfolio, the difference between the returns of the portfolio and the expected returns of the portfolio, and the expected returns of the portfolio, and the expected returns of the portfolio would form the base of determining, would form the base of determining, would form the base of determining, would form the base of determining whether the portfolio, will form the base of determining whether the portfolio is correctly valued as follows. Will form the base of determining whether the portfolio is correctly valued as follows. Of determining whether the portfolio is correctly valued as follows. Whether the portfolio is correctly valued as follows. So you want to make now the decision in relation to that. So the first one, we shall say that if expected return of the portfolio is greater than the return of the portfolio. So if expected return of the portfolio is greater than the return of the portfolio, is greater than the return of the portfolio, then the portfolio is undervalued. Then the portfolio is undervalued, or it is super efficient. Then the portfolio is undervalued or super efficient. Then the portfolio is undervalued, or it is super efficient, or it is super efficient. Then the second one is that if expected return of the portfolio is less than the return of the portfolio, if expected return of the portfolio is less than the return of the portfolio, then the portfolio is overvalued. Then the portfolio is overvalued. Then the portfolio is overvalued, or it is inefficient. Then the portfolio is overvalued, or it is inefficient. The portfolio is overvalued, or it is inefficient. Then the last one, number 3, is that if expected return of the portfolio is equal to the return of the portfolio, if the expected return of the portfolio is equal to the return of the portfolio, then the portfolio is correctly valued. Then the portfolio is correctly valued. The portfolio is correctly valued, or it is efficient. It is correctly valued, or it is efficient. it is correctly valued, or it is efficient. Correctly valued or it is efficient. So I'll give you a brief illustration. So in an example, we can summarize that. Consider the following information. Consider the following information. Consider the following information. So Roman letter 1, sorry, before the Roman letter 1, we can just simplify them. We can have the portfolio. We can have the column for the portfolio. Then expected return of the portfolio. Expected return of the portfolio in form of the percentage, and also the standard deviation of the portfolio in form of the percentage. So we have the portfolio, expected return of the portfolio in the form of the percentage, then the standard deviation of the portfolio. So we start with portfolio 1. So portfolio 1, this one is 19. Then the other one is 8. The standard deviation will be 8. Then in portfolio 2, we shall be able to have this as 25, then 12, 25, then 12. Then the third one is supposed to be 16. And also 6. Then the fourth one is supposed to be 32. Then 16. Then number 5, we have 22.5. Then 10, 22.5. Then 10. Then number 6. So I have it as 8. Then 2. So that's now the information that is given. Then another paragraph, we can note that the expected return of the market, portfolio, the expected returns of the market portfolio is 12%. The expected return of the market portfolio is 12%. And the standard deviation of the market is 4%. The standard deviation of the market is 4%. Then you continue on the same by noting that the risk-free rate is 5%. The risk-free rate is 5%. The risk-free rate is 5%. So required Roman letter 1 is that using the capital market line, advise the investor of which of the above portfolios are efficient, or inefficient. or inefficient. Then Roman letter 2 is that in case of inefficient portfolio, in case of inefficient portfolio, in case of inefficient portfolio, in case of the inefficient portfolio, determine the standard deviation of the portfolio. 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 For the portfolio to be efficient, determine the standard deviation of the portfolio. For the portfolio to be efficient. For the portfolio to be efficient. For the portfolio to be efficient. For the portfolio to be efficient, using the information above. Using the information above. Using the information above. So we want now to arrange the information so that we can be able to check which portfolio is efficient, inefficient, or super efficient. So we shall be having a column for the portfolio. We can have the column for the portfolio. Then return of the portfolio, which is given by the risk-free rate, expected return of the market minus the risk-free rate, divided by the standard deviation of the market, multiplied by the standard deviation of the portfolio. Then we shall also be having the expected return of the portfolio. Then we make the decision. Then we make the decision. Then make the decision on the basis of that. So we have the portfolio, then return for the portfolio. Then we already have the expected return for the portfolio. Then we make the decision. So starting with the portfolio 1, starting off with portfolio 1. So return for that risk-free rate was given in the note before the additional, sorry, the additional information. So you can see the risk-free rate before required. Yeah, so you are given 5. So before required, we have given you the risk-free rate. So it is 5%. It is 5%. Then plus, still in the same paragraph, we have expected return for the market. 12%. Yeah, so 12. Then we also minus 5. So still in the same paragraph, there is the standard deviation for the market. So they are able to be 4%. Then this standard deviation for portfolio 1, when you check under portfolio 1, you can see the standard deviation. You can see, is it 8? Yes. Yeah, so standard deviation for portfolio 1 is given as 8. So now we compute that. We get the value for that question. So the question is in your notes. Someone has just come in. We have written the question. It is supposed to be in your notes. So this one is giving us around which return? It's giving you 19. So expected was also given as 19. Yeah, so that means that you can see expected return of the portfolio is equal to the return of the portfolio. So that portfolio is efficient or correctly valued. So the decision is that it is efficient or correctly valued. So it is efficient or correctly valued. Is efficient or correctly valued. So that's now for portfolio 1. That is now meant to be for portfolio 1. So we go to portfolio 2. We go to portfolio 2. We go to portfolio 2. So risk-free rate is not changing. It will remain the same. Even this one, the only item which will be changing is the standard deviation for the portfolio. So the standard deviation for portfolio 2, is it 12? Yeah, so they are able to give you the value of 12. So from there, we can get that here. We are getting 20. We are getting 26. We are getting 56. Then expected return was given as per what? It is 25. So you can see under this one, expected return of the portfolio is less than the return of the portfolio. So you can see expected return of the portfolio is less than the return for the portfolio. So you conclude it is overvalued or inefficient. So it is overvalued or inefficient. It is overvalued or inefficient. It is overvalued or inefficient. So that is now portfolio 2. So we go to portfolio 3. Portfolio 3. So it is 5 plus. So 12 minus 5 also divided by 4. So the standard deviation for that is 6. Yeah, so you also compute the figure, then you see it to be able to give us how much. Sorry? It is 15.5. 15.5. So expected was given. They gave us 16. So this one is super efficient. So because the expected return of the portfolio is greater than the return of the portfolio. So because the expected return of the portfolio is greater than the return of the portfolio. So that portfolio is super efficient. It is super efficient or undervalued. It is super efficient or undervalued. So it is super efficient or it is undervalued. It is super efficient or it is undervalued. So you got to number 4. The standard deviation is 16. So you are getting 32. That's 3. So expected return, you are given 32. Yeah, so you can see this one is inefficient because expected return is less than the return of the portfolio. So it is inefficient, or it is inefficient or overvalued. So you do the same for number 5 and 6. We do the same for number 5 and 6. We do the same for number 5 and 6 for that.
Umeona? Sasa hiyo yake ni second generation. Hiyo ilikuwa 6, alafu hii RAM yake ni 8, ndio ilikuwa 4. Unaona bado tutaenda sana ile kwa kuchagua kidogo. Alafu sasa hiyo nataka kumwambia ati labda hiyo kuna that frame. Namwambia bado bila haki ya touch. So ni mwambie ni class kwa sababu kutoka.
So the last one, is it super or inefficient? It is inefficient. How about number 5? Number 5 is efficient. Number 5, it was 22.5. Then expected return was also 22 points. So the difference, they are the same. So it is efficient. So it is efficient. So that was meant to be your Roman letter 1. That was meant to be your Roman letter 1. That was meant to be the Roman letter 1. So let us now check the Roman letter 2. In case of inefficient portfolio. So how many are inefficient? When you check through what we have calculated. How many are inefficient? Yeah, that is number 1. Sorry, number 2. Number 4 and yeah, so 2, 4, and 6 are inefficient. 2, 4, and 6 are inefficient. So now the examiner is asking you when they are inefficient like that. So what should be the standard deviation of that portfolio for the portfolio to be efficient? So for the portfolio to be efficient, you see they must be the same. For the portfolio to be efficient, the two must be the same. So we want now to assess what should be the standard deviation for the two to be efficient. What should be the standard deviation for the portfolio to be efficient? So for the portfolio to be efficient, so we start with portfolio 2. We start off with portfolio 2. So for the portfolio to be efficient, expected return of the portfolio must be equal to the return of the portfolio. So for the portfolio to be efficient, expected return for the portfolio must be equal to the return of the portfolio. So what are we given as expected return for portfolio 2? The expected return for portfolio 2 it is 25. So should it be equal? So risk-free rate should know. This one we use the formula. Remember the formula for the capital market line. Risk-free rate was what? 25 plus. Expected return for the market was 12. Yes. Also minus 5. Then the standard deviation for the market, remember it was 4, isn't it? So the question is asking us, what is this standard deviation of the portfolio for the two to be the same? So when the two are the same, that's when the portfolio will be what? Efficient. So you want to make now this standard deviation for the portfolio to be a subject. Yeah. So what we do will be 25 will be equal to 5 plus 12 minus 5 is that 6, 7? Yes. So 7 over 4. Then standard deviation of the portfolio. So this one we have to cross. So it is 25 minus 5 will be equal to 7 over 4. So this one should be 27 over 4. So we make the standard deviation of the portfolio to be the subject. We make so this is the same as 20 multiplied by 4 to be equal to 7, the standard deviation for the So making the standard deviation for the portfolio to be the subject will be the same as 20 multiplied by 4 divided by 7. So when you compute, it's likely to give us around which around 14 points or 11. 11.43. So that is now for portfolio 2. 11.43. That's now for portfolio. So the other one was portfolio 4. The other one was meant to be portfolio 4. So we do the same for portfolio 4. We do the same for portfolio 4, where we say the expected return for the portfolio must be the same as the return for the portfolio. So expected return for that portfolio, was it 8 or, sorry, it was 32, isn't it? Yeah, so it should be 32. So 32 should be equal to 5 plus. So 12 minus 5 divided by 4. So make also the standard deviation for the portfolio to be the subject. We also make the standard deviation of the portfolio to be the subject. So that is now for portfolio 4. So we shall do the same for portfolio 6. We shall also be required to do the same. For portfolio 6. So when you do the same for portfolio 6, remember expected return of the portfolio must be the same as the return for the portfolio. So that one, it was 8. So it should also be equal to 5, then plus 12 minus 5. So you also make that value be the subject. You also make that question to be the subject. So the one for portfolio 4, you are getting 15 points. Then now the last one should be 1.71, like that. So that's now in relation to that question. So there's a question I've sent to the group for the class. So the past papers are not yet ready. So there's a question for September 2015. September 2015, question 5, part B. So I've sent the question to the group Those who are online, you check. There is a question in the class group. It is question 5. That question is for the pilot paper for September 2015. September 2015. September 2015. It is for the sitting of September 2015. So it was question number 5, part B. So are we able to see that question? Yeah, so let us go through the question. Let us go through that question. They were saying that ABC Limited investment fund comprises of 4 major projects. It comprises of 4 major projects. Details for which are as follows. So they gave you the stock, number of the shares, market price per share, expected return, standard deviation of the return, and also the correlation with the market. So the risk-free rate of return is 5%, and the probability distribution of the market portfolio return are given as follows. So they also gave you the variance of the return of the market portfolio, which was given as 169%. So we require the standard deviation for the market. So to get the standard deviation for the market, you simply get the square root of 169. That should be 13. That should be able to give you 13. So required, we are only answering Roman letter 1. Using the portfolio theory, evaluate whether the portfolio is super efficient, efficient, or inefficient. We want to evaluate whether the portfolio is super efficient, efficient, or inefficient. Super efficient, efficient, or inefficient. So one item that is not given is expected return for the market. So first, we compute expected return for the market. We need to get expected return for the market. So to get expected return for the market, the question gave you forecasted return of the market and their probability. So we have 15 multiplied by 0.2. Then we also add, there is 10, also by 0.15. Then the next one is 15. Is it 15? Also by 0.3. Then plus. The other one is 20. Also multiplied by 0.25. Then also plus 25. Multiplied by 0.10. So when you add them together, they should be able to give you the expected return of the market. They should be able to give you the expected return of the market. We should be able to come up with the expected returns of the market. The expected returns of the market. We should be able to come up with expected returns of the market. We should be able to get expected returns for the market. So it is likely to give us around which figure? No one has computed 16.5. So we are getting the value of 16.5. We are getting 16.5. So the next item, remember we arranged like the other question. We just arranged like the other question where you will be adding the portfolio, then expected return of the portfolio, sorry, the return of the portfolio, return of the portfolio, risk-free rate, then expected return for the market minus the risk. start with expected return of the portfolio, then we should be able to make the decision. We should be able to make the decision on the basis of that. We need to see how to make the decision at that point. So there were 4 of them. So you start off with stock A or portfolio A. Stock A or portfolio A. So risk-free rate was given. The risk-free rate was given as 5%. The risk-free rate is 5%. Expected return for the market is what we have just calculated. We got 16.5. We got 16.5. Also minus 5. So standard deviation of the market, when you check at the end of the question before required, they gave you a variance. They gave you a variance. So to get the standard deviation of the market, simply get the square root of 169. So to get the standard deviation for the market, at the end of the question, so it is 13%. Yeah, so this one you divide by 13. Then standard deviation for portfolio A or stock N, the question has given you 15. The question has given you 15. Sorry. So you compute and see the value, which will be able to give us that. 16.27. So 18.27. So this one is giving 18.27. So expected return was given. You can see 10%. Expected return is 10%. So from this observation is that expected return of the portfolio is less than return. So this one is inefficient. So you indicate it is inefficient. That portfolio A was inefficient. It was inefficient. So that's now the concept. So I would like you to do the same for B, C, and also D. B, C, and also D. So the concept remains the same. The concept just remains the same. So now you combine them using the same format and establish how many are efficient, inefficient, or super efficient.
Answers. Peke yake. Kuna swali tunaona kidogo. Last minute, the project of some work. Anakuwa ile serious. Msikia mtu anavuga kufikiria anaanza kuandika vitu kutoka kwa na ile wewe.
So all of them are inefficient, isn't it? Yes. So someone is asking the meaning of the risk-free rate. Then what is implied by super efficient, inefficient, and efficient? So all those terms were discussed in financial management of section 3. The valuation of securities. So you are advanced. That was covered in section 3 under the valuation of securities. That's where we explain what we mean by efficient, inefficient, or super efficient. So that concept is examinable at the lower level. Here we are practical. We now apply the concept. But the meaning, if we go there, we shall just be wasting our time because it was for section 3. Then it is not required at your level. So no one will ask you what is efficient, inefficient, or super efficient. They wanted you to demonstrate whether it is efficient, inefficient, or super efficient. Then the risk-free rate is the minimum interest rate. Yeah, when they talk about the risk-free rate, is the minimum interest rate charged by the central bank of any government. So the risk-free rate is simply the minimum interest rate charged by the central bank of any country. Yeah, so that is what we mean by the risk-free rate. So below that, there will be no problem in relation to that risk. So, but even still for now, there is no need of you knowing about that element of the risk-free rate. So let us go to the question. So still, we have calculated for each separately. We have calculated for each separately. We have calculated for each separately. So we now combine them together. We also need to get the combined. What you have computed is for individual. Let us now compute for the combined. Let us compute for the combined and see whether the combined portfolio is efficient, inefficient, or super efficient. whether the combined portfolio is inefficient, efficient, or super efficient. So let us get for the combined portfolio. We want to get for the combined portfolio. Combined portfolio. So we check for the combined portfolio. So for us to combine, we need to get the total market value. We need to get the total market value. We need to get the total market value. So to get the total market value, you can see stock A, they were able to give you 2 million shares. So we take 2 million shares multiplied by the market price per share, which has been given as 13. So that I suspect should be 60 millions. It will be able to give you 60 millions. Then we go to B. B, there are 1 million shares. There is 1 million shares. We multiply by 25. So it will still remain 25 millions. It will still remain 25 millions. We go to C, which will be 2 millions. 2 millions. We multiply by 20, which will be 40 million. And finally, D, you are able to give us 3 millions shares. Market price per share was 25. So is it 75 millions? So add them together. Give me the total. So remember to add them together. Then you give me the total for that. Exactly? Yeah, so exactly 200. So we shall first compute the combined expected return for the portfolio. We need to get the combined expected return of the portfolio. We need to come up with combined expected return of the portfolio. So to get the combined expected return for the portfolio, so we take A, 60 million, divide by the total, which is 200 million. So expected return for A, you can see in the question was given as 10. It was given as 10. Then we add. The one for B, you take 25 millions. We also divide by 200 millions. So this one we multiply by 18 like that. We add, the next one is supposed to be 40 millions. We also divide by 200 millions. So we multiply by, that one is 15. Then we also add. The next one is meant to be. The next one is meant to be 75. Also divide by the total 200. Then multiply by 13. So combine them together so to get the combined expected return of the portfolio. So to come up with the combined expected return of the portfolio. Starting point. 13.125. So I will also compute the combined standard deviation of the portfolio. We shall also be required to compute the combined standard deviation for the portfolio. We also need to get the combined standard deviation of the portfolio. So to get the combined standard deviation of the portfolio, it will be 60 millions divided by 200 millions. So we multiply by, we should be required to multiply by. So standard deviation for A was 15. The standard deviation for N was meant to be 15. Then we also add, the next one is 25 millions divided by 200 million. So the standard deviation for B was given as 20. Then the next one, it is meant to be 40. You also divide by 200. This one we multiply by, is it 14? Yes. And the last one also divide by 200. So this one we multiply by 18. So that you get the combined standard deviation of the portfolio. So to get the combined standard deviation of the portfolio, we get the combined standard deviation of the portfolio. So, after getting the combined standard deviation for the portfolio, it is giving us around this figure, 16.55 like that. So we also get the combined returns of the portfolio. The combined return of the portfolio, combined return of the portfolio will be given by risk-free rate plus expected return for the market minus the risk-free rate. Then standard deviation for the market. Then also the combined standard deviation of the portfolio. The combined standard deviation of the portfolio. So risk-free rate, we know it is 5. Then plus, we know expected return for the market. Was it 16.5? Expected return for the market. 16.5. Yes. So you take the 16.5 also minus 5. So we know the standard deviation for the market was 13. Yes. So now the combined standard deviation is 16.55. So it is 16.55. So that should be able to give us the combined expected returns of the portfolio. So to come up with the combined expected returns of the portfolio. So to get the combined expected returns of the portfolio. So 19.64. 19.64. So we are comparing the expected return and the return, so that we tell whether the portfolio is super or inefficient. So we get the combined expected return of the portfolio minus the combined return of the portfolio. So you can see combined expected return. We got 13.125, 19 points. So it is inefficient. You can see the combined expected return is greater than the return for the portfolio. So overall is also inefficient. Or alternatively, just say that from this one is greater than, so less than. Instead of subtracting, just compare. The combined expected return of the portfolio is less than the combined return of the portfolio, because this one is 13.15, then the other one is 19.64. So it is inefficient. So also the overall portfolio is inefficient. Individual is already inefficient, and also the overall was also inefficient. So that was the explanation you are meant to give. So maybe we can now make a conclusion. We can now make a conclusion by summarizing that individual portfolios are inefficient. Individual portfolios are inefficient. Individual portfolios are inefficient. And the overall portfolio is also inefficient. Is also inefficient. Is also inefficient. Is also inefficient. Therefore, the investor will be advised. Therefore, the investor will be advised. The investor will be advised to change the composition of the portfolio. Will be advised to change the composition of the portfolio. Will be advised to change the composition of the portfolio. Yeah, that's just in case, or in fact, they can be asked to reject, because you can see it is less in that manner. So that's now on that element. So let us now have limitations of the portfolio theory. We can now have limitations of the portfolio theory. Limitations of the portfolio theory. Limitations of the portfolio theory, or assumptions. Limitations of the portfolio theory, or the assumptions, or disadvantages. Someone can ask you the limitations or assumptions or disadvantages of the portfolio theory. So they will refer to the same thing. The three of them refer to the same. So number one is that, we note that it deals with the total risk. It deals with the total risk. It deals with the total risk. It deals with the total risk or business risk. It deals with the total risk or business risk as measured by the standard deviation of the portfolio. So it deals with the total risk or business risk as measured by the standard deviation of the portfolio. As measured by the standard deviation of the portfolio. However, in practice, some risk is minimized. However, in practice, some risk is minimized. However, in practice, some risk is minimized by holding the portfolio. However, in practice, some risk is minimized by holding the portfolio. Some risk is minimized by holding the portfolio. So in our previous class, you remember we calculated the percentage of risk minimization, so we can minimize that. The number 2 is that it uses the historical data. It uses the historical data. It uses the historical data to analyze the portfolio. It uses the historical data to analyze the portfolio. It uses the historical data to analyze the portfolio, and the probabilities assigned to each outcome, are subjective. So it uses the historical data to analyze the portfolio, and the probabilities assigned to each outcome are subjective, and the probabilities assigned to each outcome are subjective. So that's now another challenge. Yeah, this information we are using is from the past. It is history. So we cannot use that to project the future. It will be having a challenge. The number 3 is that it assumes that there are no economies of scale. It assumes that there are no economies of scale. It assumes that there are no economies of scale. There are no economies of scale. And that the expected return of the portfolio, is the weighted average. The expected return of the portfolio is the weighted average, of the individual securities expected returns. It is the weighted average of the individual securities expected returns. It is the weighted average of the individual securities expected returns. So that's now another challenge. Yeah, it assumes that there is no additional benefit. Economies of scale are simply additional benefit when you combine some portfolios together. But for this one, when you compute expected return, it was just a weighted average. There was no additional benefit for the same. Then the next one is that number 4. It uses the indifference curves. It uses the indifference curves. It uses the indifference curves. It uses the indifference curves to measure the utility. It uses the indifference curves to measure the utility, of the individual investor, to measure the utility of the individual investor, to measure the utility of the individual investor, to measure the utility of the individual investor, which is not practical. So to measure the utility of the individual investor, which is not practical, So utility is the satisfaction you derive when you invest in a given project. So then they use the graphs to show that. So that is not real. I cannot be able to measure how you are satisfied maybe with a given product by a curve. Yeah, it is an individual concept. The challenge is normally that I can consume a product today, I feel more satisfied. But tomorrow when you consume the same product, maybe it has changed the taste. Yeah, you feel that it is not giving the same value that you are getting. So that one cannot be measured. Then remember, utility keeps on changing. You can get satisfied with the air, but tomorrow when you consume the same air, the satisfaction may be different from that. So that's now the challenge when it comes to measuring using utility. Then number 5 is that it assumes that investors are risk averse. It assumes that investors are risk averse. It assumes that investors are risk averse. Investors are risk averse, i.e., the investors fear the risk. The investors fear the risk. The investors fear the risk. However, in practice, they are risk takers. However, in practice, they are the risk taker. However, in practice, they are the risk taker. Remember, an investor is a risk taker. They are not sure about tomorrow, but they invest. So they are not risk averse. The next one is that the market portfolio or the optimum portfolio, the market portfolio or the optimum portfolio, the market portfolio or the optimum portfolio is a theoretical portfolio, is a theoretical portfolio since there is no portfolio in the market, since there is no portfolio in the market, which can represent, there is no portfolio in the market which can represent all the companies in the industry, which can represent all the companies in the industry, which can represent all the companies in the industry, which can represent all the companies in the industry. Then the last one is that it assumes that all the projects are divisible. It assumes that all the projects are divisible. It assumes that all the projects are divisible. All the projects are divisible. However, in practice, indivisible projects exist. However, in practice, indivisible projects exist. However, in practice, indivisible projects exist. Indivisible projects exist. So that is now the first part of our topic, the portfolio theory. So the topic was portfolio theory and CAPM. So let us now go to the second part of our topic. We now check the second part of the topic. We got the second part of the topic, the capital asset pricing model. The capital asset pricing model. The capital asset pricing model. So that is the same as CAPM. That is the same as CAPM. Capital asset pricing model. The capital asset pricing model, or simply CAPM, or simply CAPM, or simply CAPM. So when it comes to this area, remember that when you are dealing with the portfolio theory, you are able to use the capital market line. But this one we should be using the security market line. Then, when you are using the portfolio theory, the measure of the risk was the standard deviation. But now this one, we should be using the beta factor. We shall use the beta factor to measure the risk. That's the major difference. Under portfolio theory, we use the capital market line. But under the CAPM, we use the security market line. Then also remember, under CAPM, under the portfolio theory, you are using the standard deviation to measure the risk. But under CAPM, we shall use the beta factor to measure the risk. So those are the key differences which we shall be discussing at that point. So we can introduce something brief on that by noting that this is a model, that's now CAPM. This is a model. This is a model which is used in estimating the returns of the individual security. It is a model which is used in estimating the returns of the individual security. In estimating the returns of the individual security. Estimating the returns of the individual security. Then we continue by noting that it operates under the following assumptions. 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 Number one is that investors are rational. Investors are rational. Investors are rational. And they prefer more returns. And they prefer more returns. And they prefer more returns for taking greater risk. They prefer more returns for taking greater risk. They prefer more returns for taking greater risk. Yeah, so at the moment they take a higher risk, we also expect them to get a higher return. That's now what is there as an investor. Investors are highly rational. When they get a loss, they pull out. Yeah, so they prefer for them to incur a higher risk. They must be promised a higher return. Yeah, that's now what would happen for the investor. The number two is that the borrowing and the lending rate is the same in the market. Borrowing and the lending rate is the same in the market. The borrowing and the lending rate is the same in the market. So that's now another assumption we should be using. So the borrowing rate and the lending rate are the same in the market. So that is just an assumption. It is not there practically, but for CAPM to hold, we must have that particular assumption. Then number three is that there are no transaction costs. 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 Then we continue by noting that lack of the transaction cost, lack of the transaction cost is meant to attract the investors. Lack of the transaction cost is meant to attract the investors. Lack of the transaction cost is meant to attract the investors. Is meant to attract the investors. Then the next one is that there are no market imperfections. 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 There are no market imperfections, i.e., these are events which makes the market to be inefficient. These are events which makes the market to be inefficient. These are events which makes the market to be inefficient, which makes the market to be inefficient. And therefore, they are ignored. 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 That's now assumption number 4. Assumption number 5 is that the model ignores the risk of insolvency. The model ignores the risk of insolvency. The model ignores the risk of insolvency. The risk of insolvency, i.e., bankruptcy is ignored. Bankruptcy is ignored. Bankruptcy is ignored. Bankruptcy is ignored. The next one is that homogeneous expectations, homogeneous expectations, homogeneous expectations, homogeneous expectations, i.e., all the investors in the market, i.e., all the investors in the market, all the investors in the market, all the investors in the market have the same, they have the same expectations. All the investors in the market have the same expectations. They have the same expectations about the risk and the returns. They have the same expectations about the risk and the returns. They have the same expectations about the market, sorry, the risk and the returns. Then number 7 is that there is no inflation. There is no inflation. There is no inflation. There is no inflation, i.e., the model assumes that the prices of the commodities will not change. The model assumes that the prices of the commodities will not change. The prices of the commodities will not change. The prices of the commodities will not change. Then the next one is that returns of a given security, the returns of a given security, the returns of a given security have a normal distribution. The returns of a given security have a normal distribution. The returns of a given security have a normal distribution. The last one is that there is a well-diversified market portfolio. There is a well-diversified market portfolio. There is a well-diversified market portfolio. There is a well-diversified market portfolio where only systematic risk exists. There is a well-diversified market portfolio where only systematic risk exists, where only the systematic risk exists. So those are now the assumptions of CAPM. Those are normally the assumptions of CAPM. So let us now look at measures of the systematic risk. We can now have a subtopic on that area as the measures of the systematic risk. We look at the measures of the systematic risk. So under that, we note that the systematic risk is measured. Systematic risk is measured. Systematic risk is measured. Systematic risk is measured using beta factor, using the beta factor or coefficient. Is measured using the beta factor or coefficient. It is measured using the beta factor or coefficient. Is measured using the beta factor or coefficient. Then another paragraph, we note that the beta factor or coefficient, the beta factor or coefficient, the beta factor or coefficient, the beta factor or coefficient is the measure of the sensitivity, is the measure of the sensitivity, is the measure of the sensitivity of the returns, of the returns, of the returns of a security or a portfolio. It is the measure of the sensitivity of the returns of a security or a portfolio. The returns of a security or a portfolio as a result of the changes, as a result of the changes in the market portfolio, as a result of the changes in the market portfolio, as a result of the changes in the market portfolio. Then we continue by noting that it is computed as follows. 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 So we already have knowledge about it. We only want to know how to compute that particular beta factor. So if you want to compute the first formula is that the beta factor of security X, the beta factor for security X will be equal to the covariance between X and the market. We divide by the variance of the market. So when you want to get the beta factor of security X, when you want to get the beta factor for security X, you simply get covariance between security X and the market. So you are able to see how to get the covariance. Then you divide by the variance of the market. You divide by the variance of the market. We divide by the variance of the market. We divide by the variance of the market. So that is what we can be able to apply. So when it comes to the second one, we also have the second formula. But to get the second formula, I had been able to show you that the correlation coefficient, remember the correlation coefficient, let's say the correlation coefficient between security X and the market. Remember it was supposed to be given by the covariance between security X and the market. We divide by the standard deviation of security X, multiplied by the standard deviation for the market. So we are making the covariance to be the subject. If we happen to make the covariance to be the subject, the covariance to be the subject will be the same as correlation coefficient between security X and the market, multiplied by the standard deviation of security X, also multiplied by the standard deviation for the market. That means this area can be replaced by this. So that now will give you a way on how to get the beta factor, the second formula. So the second formula, the beta factor of security X. So where there was the covariance, we replace it with the correlation coefficient between security X and the market, multiplied by the standard deviation of security X, multiplied by the standard deviation for the market. Then I also want you to remember this variance of the market. This variance of the market is the same as the standard deviation squared. So where we have this variance for the market, it is the same as the standard deviation for the market, also multiplied by what? The standard deviation for the market. The standard deviation for the market squared. So out of that, you see we can cancel this and that. We can cancel that. So the formula will now be equal to correlation coefficient between security X and the market multiplied by the standard deviation of security X divided by the standard deviation for the market. So finally, we can simplify it in that manner. Finally, we can be able to simplify it in that particular manner. So the last formula also to get the beta factor. The last formula also to get the beta factor of, let's say, X. To get the beta factor for security can also be given by changes in the returns of the security, changes in the returns of the security, changes in returns of security X, of security X. We divide by changes in returns of the market, changes in returns of the market, changes in returns of the market. So that will also give you the beta factor. You simply get the changes in returns of security X divided by the changes in returns of the market. Remember, that's the same as the gradient of the straight line. The difference between the highest and the lowest between the two factors. So that will be able to give us the value for that. So given the time, we shall not be able to do a question on that. So I want us to stop there for today. When we meet, we shall now get some questions in relation to that. When we meet, we shall now get some questions on that area. So let us stop there for today.